Hi everybody, welcome back to the video, and hope you guys don't mind if my son Colton joins in this video today. Say hi, Colton. He's just waking up from a nap, but I thought we'd talk about the S&P 500 Enhanced Options Income ETF in this video. Now, this is one that I just discovered actually, and the first thing you'll notice is that it pays a 40+% dividend yield, which is quite high, and it pays these on a monthly basis. But of course, there's a catch, right? So you'll see this, and it looks really nice. We have the Defiance S&P 500 Enhanced Options Income ETF, JEPY, and you'll see that they pay $6.60 in annual dividends, an insane dividend yield. So if you invest $10,000, you're going to receive $4,000 back in passive income. But wait, there's more, and that's the chart since inception. So. And it even mentions this in the prospectus, and so this is a main consideration. We'll get into this prospectus a little bit, but as you'll see here, this ETF just came out in September, as you'll see, at $20 per share, and it's all the way down to $16.38 per share. Now, one other thing I noticed is that the management fees on this are not the cheapest either, so you're going to have 0.99% total annual operating expenses, which relative to the yield you're getting, you might say, well, that's not that bad. But this does add up, and it is subtracted from whatever return you're getting. So keeping that in mind, I mean, there's a lot of ETFs that pay less than, let's say, 10 basis points or even less than 0.5%, depending on the type of ETF you're targeting. But there are definitely cheaper ETFs out there. Now, one thing you'll notice on the website here is that they do paint quite the rosy picture. You'll see that they have the first put-right ETF on the S&P 500 using daily options to seek enhanced yield for investors, and it's paid every single month. So JEPY aims to achieve consistent monthly yield distributions for investors, along with equity market exposure to the S&P 500. JEPY is an actively managed exchange-traded fund that seeks enhanced income, constructed of treasuries and S&P 500 index options. Now, their main objective is to generate outsized monthly distributions or monthly income by selling options premiums on a daily basis. And what they're doing is they're trying to realize rapid time decay, which is typical with short-dated options. And so by selling in-the-money puts, they're hoping to profit from time decay on the option and essentially buy back the option cheaper and profit on a daily basis. Now, with that, I mean, you're going to get those monthly distributions. So if you have a taxable account, that's going to be a main consideration. Now, the fund's primary objective is to seek current income, and the secondary investment objective is to seek exposure to the S&P 500 index. But here's the catch, right? So subject to a limit on potential investment gains. And this is something I noticed in the prospectus as well. You know, obviously you have the portfolio turnover. We talked about the fees. Here's the primary strategy, though. So it employs its investment strategy as it relates to the index, regardless of whether there are periods of adverse market, economic, or other conditions, and will not seek to take temporary defensive positions during such periods. Additionally, the fund seeks to use an at-the-money and in-the-money put-selling strategy to provide income and exposure to the value of the index, subject to a limit on potential investment gains as a result of the nature of the option strategy it employs. The fund's options contracts provide current income from options premiums and a limit on the fund's indirect participation in gains, if any, of the increase in the value of the index. In addition, the fund's in-the-money put options will provide some upside appreciation. You okay, buddy? You getting hungry? So it also has intrinsic value, right? So it mentions if any increase in value of the index. In addition, the fund's in-the-money put options will provide some upside appreciation, known as the intrinsic value appreciation. It does discuss this in more detail, but essentially what it's saying is you're probably not going to participate in the upside of the index. And if you look at the actual S&P 500, we know that we're in a bull market right now. The S&P 500 is positive, right? So we have a positive S&P 500. We have a positive stock market right now. But this ETF since inception is down. So once again, you know, to put simply, guys, in this video, I'm going to keep it short tonight, but the main takeaway here is you cannot always, you can't have your cake and eat it too, right? So you can't have a huge 40% dividend yield without the downside in capital appreciation. And so that's the main takeaway you guys should probably think about if you're looking to consider investing in an ETF like this. So yes, if you're looking for consistent income, or perhaps you are thinking about reinvesting these dividends and you're just going to dollar cost average this all the way down, that could be a consideration, especially with a 40% dividend yield if you're thinking about just reinvesting these dividends. But if you're actually trying to live off this, keep in mind that you can get those high yields, but at what cost, right? So if your principal is going down by this amount on a regular basis, what happens, right? So if you're going from $20 per share down to $16 per share from September, let's say you invest $100,000 or whatever you put in, if you're trying to live on this in retirement as part of like a pension plan and your 401k or IRA or something, what happens to your principal, right, over the long term? Even though you're getting those yields, what really happens over 5 years with this ETF? Does this reverse split? Do you lose a significant amount of your principal? Because that is one of the main risks they're discussing in this prospectus. And so, you'll see why invest in the fund, right? So generating monthly income and seeking to participate in a portion of the potential gains experienced by increases in the value of the index. And so the fund strategy will cap its potential gains if the index increases in value. So primary consideration there, right? So it's going to cap its potential gains if the index increases in value, which means you're not going to have any more upside than what's already capped within the strategy they're utilizing, essentially. The fund strategy is subject to all potential losses if the index loses value, which may not be offset by the income received by the fund. So the fund does not invest directly in the index. The fund does not invest directly in companies that comprise the index. And if you're a fund shareholder, you are not entitled to any dividends paid by any companies that comprise the index. And this goes back to the option strategy that they're employing with those cash secured puts, trying to capture the daily time decay on those options. And by doing that, they hope to pay out the monthly, essentially those monthly distributions. And as of lately, from what we've seen thus far, it seems to be a quite significant yield you're getting. And you just have to ask yourself what your goals are long term. Because you could essentially take this ETF and look at it like, I'm just going to reinvest these dividends, build my share count, and then get a huge monthly paycheck. Even if my principal's going down, I'm going to be well dollar cost averaged, and I'm going to start getting those monthly dividends. But at what cost, right? So how much are you going to have to dollar cost average if this ETF keeps on going down? If it's not really participating in the upside, and then it's going to participate in the downside of the index, there's risk of all of that happening in any kind of market condition. And we're already seeing how this is performing. So this is most definitely primary consideration. I mentioned those higher fees too, definitely higher than a lot of other ETFs we've seen out there. Quite honestly, guys, this is not my favorite from what I see so far. This looks very enticing, but you always have to consider, another ETF I've discussed on the channel, for example, is QYLD. And if you look at this one, you'll see that it looks okay. So over the last 6 months, we're up 2%. Over the last year, we're up 1.63%. But then if you go over the longer term, you'll see a consistent decline. And this it's a different strategy they're utilizing, but they're utilizing an option strategy, and they're not really getting the upside appreciation benefit. Now, one of them that I do kind of like, and I've discussed this one on the channel, this is a bit different. We have JEPY, right? And we also have JEPY. These are all ETFs that I've discussed. This also does an option strategy. You're not going to get those, so you're not going to get as high of a dividend yield as you would with this ETF that we're discussing now. But with these ETFs, you also have the potential for upside appreciation. As you can see, over the last year, we're up like 5% with this ETF. It's better than being down, 20% in less than 1 year for this ETF. If we actually look at the S&P 500, the one we were just looking at there, let me type it back in here, sorry. Let me get back to that real quick. I just want to show you the Google chart one more time and how this has fared since inception. Since this actual ETF came out onto the market in September, as you can see, $20 per share, and now we're trading at $16.40. So it's kind of showing its true colors already. We read about how it may not benefit from any index appreciation, right? So if the index goes up in value, it might not participate in that upside. And so that's a major risk and a major consideration of investing in this fund. But if you like those high income yields and that's all you're focused on, if you're in retirement and you want to throw a portion, I would say a portion of your retirement portfolio in here, because this is very risky, I would say, with the risk of downside capital appreciation. That's my opinion. You know, always look at this yourself from your own investing goals, your own risk tolerance, and what you're looking at. But it even goes over here, the principal investment risk. And I said I was going to keep it short tonight, but I guess not. So essentially what we have here is the entire prospectus going over all of these small details, which are very, very important. And I would recommend reading this. You can come over to the website and you can look at their principal investment risk. Just type in the JEPY stock or ETF prospectus, and you'll see here that you can pull it up on their website. Not JEPY, but JEPY, the one we were just looking at. And you will see that you can come over to their website here and get their prospectus. So with that being said, guys, thank you so much for tuning in to another video. Colton, thank you for joining us in today's video as well. Say bye, Colton. I think he's passed out again, but he's only less than a month old, so maybe he'll take over this YouTube channel someday and do a much better job than I can. But with that being said, thanks so much for tuning in, guys. God bless. Hope you all have a great evening, and we'll see you in the next video. Take care.